Have you ever noticed how some company stocks, they seem to possess a life of their own? It's almost as if they're playing by a different rule book, defying all the traditional market logic we hear about.
Oh, absolutely. They swing wildly, generate just endless buzz.
Exactly, and ignite these really fervent debates among investors. It leaves you wondering, am I missing something fundamental about how these companies are valued?
Right. Is there some secret sauce?
And when I think about this phenomenon, one company immediately springs to mind, almost instantly: Tesla Inc. Its shares are, well, a prime example of this captivating, often perplexing dynamic.
Couldn't agree more. The ride for Tesla investors, particularly in recent months, has been nothing short of a dramatic, heart-stopping roller coaster, really.
Okay, so let's unpack this. Today we're doing a deep dive into Tesla Inc., ticker symbol NASDAQ, TSLA. Our mission really is to navigate the perplexing, often contradictory signals surrounding its stock.
Yeah, it's been a period of intense volatility. Some unexpected twists, too, making it incredibly challenging for anyone. I mean, seasoned institutional investors, individual shareholders, you name it, trying to figure out where this EV and, let's face it, technology giant is actually headed next.
Right. So our goal is to extract the most crucial distilled insights from the recent market commentary and analyst reports that you've shared with us. We want to help you make coherent sense of the intense, almost like an intellectual tug of war, raging between the most ardent bulls and the most skeptical bears.
And we'll explore in detail why some analysts continue to see massive upside, predicting, exponential growth, while others are sounding pretty significant alarms, forecasting substantial risk. It's quite the split.
Ultimately, we want to help you understand what this conflicting yet incredibly rich information truly means. Not just for Tesla, maybe, but for your broader understanding of market dynamics and, well, investor psychology, too.
That's right. For this deep dive, we've carefully pulled together insights from the latest market analyses, excerpts from reputable analyst reports. Stuff that really captures the pulse of Wall Street's deeply, almost stubbornly divided opinion on Tesla.
It really is divided, isn't it?
Oh, absolutely. But as you mentioned, this isn't just about understanding one specific company. Tesla is our focus, sure, but it serves as a truly fantastic, almost textbook case study.
A case study in what, exactly?
Well, and how powerful narratives about the future, the sheer, often...
Okay, sounds good. So let's begin by charting Tesla's wild ride, particularly over the last quarter or so. Our sources vividly describe the beginning of the year as a period of significant, well, pain for investors.
Pain is a good word for it.
Imagine watching your investment bleed value day after day. That was apparently the reality for many Tesla shareholders during the first quarter. What exactly was happening there? How did it set the stage for, well, everything that followed?
Yeah, it was a challenging period, to say the least. Many investors were really feeling the squeeze. Tesla shares experienced a pretty significant downturn, definitely underperforming the broader market.
And this pain, as the source calls it, it wasn't without reason, right?
No, not at all. The company had faced a series of negative headlines. There were concerns over softening demand, especially in key markets like China. Intense price competition was heating up, too.
Right, the price cuts.
Exactly. And then there was some cautious guidance from the company itself regarding future growth, whispers about market saturation, maybe a slowdown in EV adoption generally,
Yeah.
even just a broader cooling off in the tech sector. All of that contributed to this tangible sense of investor apprehension.
So people were genuinely worried.
Yeah, genuinely worried about Tesla's ability to maintain those previously sky-high growth rates. It felt like a period where, frankly, the market seemed to have lost a bit of its faith, or at least its aggressive optimism, in Tesla's immediate trajectory.
And what's truly astonishing, and something that genuinely caught many on Wall Street by surprise, is the stark contrast to what happened next.
Yeah.
You mentioned that significant pain. But then, in less than 3 months from that painful low, shares of Tesla managed to gain, was it the better part of 50%?
Yeah, a huge jump.
That's not just a rapid turnaround, it's a jaw-dropping reversal.
Yeah,
It fundamentally reshapes the narrative around the stock in a very short period.
it really did.
When you see that kind of whipsaw action, that extreme volatility followed by such a powerful rebound, you have to ask, what on earth caused such a swift and decisive reversal? It feels almost counterintuitive, given those earlier concerns.
It absolutely does feel counterintuitive. And our sources point to a few key stated reasons for this unexpected surge. It paints a clearer picture of how market sentiment can just shift on a dime.
Okay, what were they?
Well, one notable factor, perhaps surprisingly, was the perception around CEO Elon Musk's public role. There was this growing narrative that his stepping back from White House duties.
Right, disengaging from some of those political advisory roles and maybe some controversies.
Exactly. That might be interpreted by investors as a deliberate refocusing on the core business of Tesla. The idea, subtly at first, then maybe more overtly, was that reducing external distractions or political entanglements could potentially be seen as a significant positive.
Huh. So less noise, more focus on the company itself?
That seemed to be the perception. It suggested he might be dedicating more energy, more strategic focus, back to Tesla's operations, its product roadmap, its long-term vision, rather than splitting his attention across, numerous high-profile endeavors. This shift, even if it was symbolic, seemed to resonate with investors looking for a clearer path forward.
That's a fascinating, almost non-traditional factor, isn't it?
Right.
It really highlights how investor sentiment can be swayed by elements that go way beyond just quarterly earnings reports or balance sheets. It underscores the powerful role of leadership perception.
Definitely.
But beyond that, another huge driver mentioned in our analysis was the increased excitement and anticipation around the company's much-awaited Robotaxi launch.
Ah, yes, the Robotaxi hype. That was big.
Tesla has always been a company where forward-looking tech advancements and disruptive visions, sometimes more so than just current earnings or traditional sales figures, heavily influence investor sentiment. The prospect of a truly autonomous, dedicated robotaxi fleet clearly captured imaginations, injecting a fresh dose of optimism into the stock.
It wasn't just another car model they were talking about?
No, exactly. It was framed as a fundamental shift in the company's entire business model. Potentially huge.
And the third reason, which is quite common in market psychology, something we see play out repeatedly, was this belief that the worst case scenario had already been priced into the stock.
Okay, explain that a bit. Priced in.
Right. It's not just wishful thinking. It's a technical concept in market analysis. It basically implies that the market, during that earlier period of pain, had already fully accounted for and discounted the most negative potential outcomes in news. So whether that was a slowdown in sales, a dip in profitability, increased competition, whatever it was.
So all the bad news was already reflected in the low price.
Exactly. When a stock hits that point where all the bad news is ostensibly baked in, any subsequent positive news or even just stabilization without further negative surprises can act as a powerful catalyst.
Like a coiled spring.
Precisely. It's like a coiled spring. With all the weight of negativity already bearing down, any release of pressure can trigger a rapid bounce. It leaves room only for upside surprises, at least in the short to medium term.
So for you listening to this, it really underlines a few critical lessons. First, it shows how incredibly quickly market sentiment can pivot, just on a dime.
Very fast.
What's seen as a negative one day can, with a slight shift in narrative or new catalyst, become a powerful positive just weeks later. Second, it highlights how diverse and sometimes non-traditional factors, like a CEO's public profile, perceived focus, or the promise of future tech that hasn't even fully materialized yet, can significantly influence a stock's performance.
Absolutely. These factors can, at times, even override immediate financial realities or traditional valuation metrics. It's really a testament to the enduring power of a compelling narrative in the investment world, especially for a company like Tesla.
Indeed. Okay, now let's fast forward from that dramatic rebound to the current state of affairs. Since the first week of June, the stock has mostly been in a phase our sources describe as consolidation, showing what's typically called sideways action.
Yeah, it's like the market collectively took a deep breath after that intense sprint upwards. Things settled down a bit.
And for those of you maybe not steeped in every nuance of market lingo, when we talk about consolidation and sideways action, after such a dramatic run-up, what does that typically imply? What's going on with investor behavior there?
It generally means a period of indecision, or digestion, perhaps. A pause after such a rapid and significant surge. The market or, the collective body of investors just takes a breath.
So people deciding what to do next.
Exactly. It's a time when those who bought low might be taking some profits off the table. Meanwhile, those who missed the rally are evaluating if it's still a good entry point. New information is being absorbed, recent gains are being digested. Investors are essentially reevaluating the current landscape before committing to the next major directional move, whether that's up or down.
Feels like a holding pattern.
Kind of, yeah. It's often seen as a healthy pause rather than a strong trend in either direction. It reflects a balance between buyers and sellers in the short term, and it often precedes another significant move, but the direction of that next move isn't yet clear from the consolidation itself.
Okay. And despite that period of consolidation, our sources acknowledge that the stock has received its fair share of negative headlines in recent weeks.
The story doesn't stop.
So this is where the plot thickens, right? It sets up the tension we're about to explore, because even with those negative headlines swirling around, the source reiterates that there are still many reasons to like Tesla for the long term.
It's a genuine mixed bag of signals, a classic push and pull.
Which brings us to why what happened just last week is really, really interesting. It just laid bare this deep, almost irreconcilable divide among the expert analysts.
What's truly fascinating here is precisely how the market and the analysts who cover it can be presented with such contradictory information and still hold these competing viewpoints so strongly. It really underscores the unique, often paradoxical dynamics at play with a company like Tesla.
Where fundamentals and future vision seem to be in this constant high-stakes debate.
Exactly, all the time.
And that leads us perfectly into the core of today's deep dive. The battle for Tesla's future, as played out between the most ardent bulls and the most skeptical bears. Last week, we saw something truly unprecedented for a stock of this magnitude, according to our sources.
Yeah, quite unusual.
There were two very interesting and unusual things that took place simultaneously. Tesla received both a pair of sell ratings and a pair of buy ratings from established Wall Street firms, all within the same week.
Right next to each other, essentially.
For a stock that the bulls and the bears have historically fought over with such ferocity, like a prize fighter's belt, this specific event is incredibly significant. It suggests we're at a critical juncture where even established, reputable firms are taking diametrically opposed stances on the company's trajectory.
It's not just a disagreement, it's a full-blown intellectual clash being played out in public, very visibly.
So what does this all mean for you, the listener, the investor, or even just the curious observer of market psychology? This seemingly contradictory advice, one expert saying sell, another saying buy, almost shouting over each other, it can feel incredibly overwhelming, right?
Absolutely. How do you possibly make sense of that kind of binary yet opposing guidance? It's tough.
Yet, our source suggests that this very situation, this clear delineation of opposing arguments, might even make it easier to understand the true underlying dynamics.
How so?
Well, it forces a deeper look. Beyond just the headline rating, you have to dig into the core arguments driving those convictions. It's like being handed two opposing legal briefs. You have to examine the evidence presented by each side to form your own verdict rather than just accepting the top-line judgment.
Okay, I see. It clarifies the battle lines in a way.
Exactly. It's like being given two maps to the same destination, but one shows mountains and treacherous ravines and the other shows flat, open plains. You have to figure out why the maps are so wildly different and which one aligns more with your own assessment of the terrain.
Makes sense. So where do we start? The bears.
Let's start with the bear case. These bearish updates came first, at the start of last week, from two major players, Guggenheim and UBS Group, both reiterating their sell ratings on the stock, essentially doubling down on their skepticism.
That's right. These analysts were clearly unconvinced by Tesla's nearly 50% gain in just a few weeks. They seem to view that recent rally as unsustainable or simply not justified by the underlying business conditions.
So they thought the jump was overdone.
Their reports implied that the rapid surge was more about maybe a short-term market correction or a shift in sentiment rather than any fundamental improvement in Tesla's financial health. And crucially, these bearish analysts were happy to overlook the potential upside from the company's much-awaited Robotaxi launch, which, remember, was getting hyped that same week.
That's telling, isn't it? What does that focus tell us?
It tells us a lot about their focus. They were squarely fixated on the current reality, the existing fundamentals, perhaps the challenges of execution, rather than future promises or speculative ventures. They were essentially saying, show me the money now, not 5 years from now.
Okay. And one of the most vocal bears was Ronald Jusico of Guggenheim. He specifically sounded the alarm on Tesla's valuation, pointing to its price-to-earnings ratio around the 175 mark.
Whoa, 175 PE.
Yeah. Now, for context, a PE of 175 is, well, it's astronomically high in traditional investing terms.
Absolutely. I mean, to put that into perspective for you listening, while high-growth tech companies often command higher multiples, 175 just dwarfs the typical S&P 500 average, which often hovers around the low 20s, maybe mid-20s sometimes.
So what does that number actually mean?
It means investors are willing to pay an incredible 175 times the company's current annual earnings for each share. Traditionally, that signifies a company is incredibly overvalued relative to its actual profitability,
Unless what?
unless you are betting on truly explosive, unprecedented future earnings growth that makes that current multiple look cheap in retrospect. That's the gamble.
And Jusico's price target. That really drove the point home, didn't it? $175.
Yeah, $175. That really hammered home his concern, making a very bold statement. To put that in perspective again, Tesla closed out that week trading just above $320. So his target implied a potential loss of close to 50% was around the corner for shareholders if his prediction came true.
Wow, that would wipe out a lot of gains.
It would effectively push shares back at 52-week lows, erasing months of progress. It's an extreme forecast for sure. And interestingly, the source notes, Jusico, didn't provide much justification beyond stating that the company's fundamentals are deteriorating at an alarming rate.
So strong statement, but maybe light on the details in that specific report excerpt.
Right, it's a powerful statement, but it invites you, the listener, to ponder the weight of such a severe pronouncement without seeing detailed, publicly available evidence to back it up right there in the source material we reviewed. It's a classic case of a strong headline, maybe without the immediate chapter and verse.
Okay. And our source does acknowledge some of what the bears are seeing, to be fair. It mentions that Tesla's post-April recovery seems to have run out of steam, and shares have failed to kick on since their peak in late May.
True, it hasn't been a straight line up since the bottom.
So there are certainly valid reasons for caution there. The stock hasn't just marched straight up since its bounce. It seems to have hit a ceiling, at least temporarily.
Yes, those points are certainly valid concerns in isolation. And the recent earnings report, in particular, well, it was indeed one of their worst updates to their fundamentals in quite some time. They missed analyst expectations by a wide margin.
What went wrong there?
You saw declining gross margins, which is a big one, increased capital expenditures, and delivery growth that slowed more than many expected. So real fundamental issues to point to.
Okay, but, and this is the fascinating part.
Right, here's the but. What's truly fascinating, and where the market seems to be telling a different story than the bears, is that despite all this, the valuation concerns, the disappointing earnings the stock has still been setting higher highs throughout June.
So the price action doesn't match the bearish fundamentals.
Not entirely, no. The fact that the stock has remained consistently higher since that poor earnings report suggests the market, or at least a significant segment of it, doesn't care quite as much about those short-term fundamental concerns as the bears might want it to.
Which raises that big question again.
Exactly. How does Tesla's stock so often appear to defy traditional valuation metrics and short-term financial performance? It's almost as if a different, more visionary set of rules applies, at least for now, for a certain class of investors. It's like it's graded on a different curve.
It certainly seems that way sometimes. A fascinating defiance of traditional market gravity. But okay, if the bears are so convinced by these valuation concerns and the perceived deteriorating fundamentals, what on earth are the bulls seeing that makes them so incredibly optimistic? Let's flip to the other side of this battle.
Right, the bull case.
By the end of last week, Tesla had received 2 fresh bullish updates from Canaccord Genuity Group and Benchmark, directly countering that bearish sentiment we just talked about.
And these analysts were far more aggressive in their outlooks and their price targets. They signaled deep conviction in Tesla's long-term potential. Benchmark, for instance, boosted its price target to a striking $475.
$475.
Yeah. And our source highlights that this is just marginally below Tesla's street high price target of $500, which came from Wedbush earlier this month.
So we're talking about some serious upside potential, according to these guys.
Absolutely. This isn't just a slight bump. It indicates a belief in a very significant, almost 50% or more, expected upside for the stock from its current levels at that time. These firms aren't just saying it's a good stock, they're saying it's potentially poised for explosive growth.
And what's interesting, and seems to be the central pillar of their conviction, is that the bullish teams were unanimous in their optimism around the company's Robotaxi launch.
Yes, that theme comes up again very strongly on the bull side.
This wasn't just a passing mention for them, was it? It was the central pillar of their investment thesis. They see it as a key milestone in Tesla's journey to offer the most cost-effective driverless cars.
Which positions Tesla not merely as a car manufacturer, an automotive OEM.
Right, OEM. Original equipment manufacturer. Basically a traditional car maker in this context.
Exactly. They see it evolving beyond that, becoming a foundational leader in a new transformative technology. They're envisioning a future tech giant built on automation and artificial intelligence, not just selling electric vehicles.
A fundamental shift in what the company is.
Precisely. Benchmark's Mickey Legg echoed this transformative view directly, and his quote really captures the essence of the bull case. He said, in our view, the company is undergoing an evolution from a trailblazing vehicle OEM to a high-tech automation and robotics company with unmatched domestic manufacturing scale.
Okay, that's a powerful statement. High-tech automation and robotics company.
It is, and that quote is truly key because it fundamentally changes how these analysts believe Tesla should be valued. If it's no longer just an automotive company, but a robotics and automation company, well, then traditional automotive industry valuation metrics, which rely heavily on things like vehicle sales and manufacturing margins, might not apply anymore.
So the high PE ratio becomes less scary in that context.
That's their argument. A high PE ratio, in their view, becomes less concerning because you're investing in the future earnings potential of a vast, new, and potentially incredibly profitable sector, autonomous mobility services, not just the current incremental sales of cars. They're looking at a completely different, much larger, and more disruptive business model for the future, one potentially built on recurring revenue from services like rides, rather than just one-time car sales.
And our source points out that this isn't exactly a new phenomenon for Tesla stock, right? This focus on the future vision.
No, not at all. As the source says, as Tesla stock has shown time and again, it is a stronger tendency to be bought for these kinds of reasons, meaning the future vision, the promise of technological disruption, than to be sold due to valuation concerns, as flagged by Guggenheim. It's almost like a pattern has emerged over the years, a distinct characteristic of how this particular stock behaves.
The narrative often wins out over the current numbers.
It seems that way, and the evidence for this bullish tendency is quite compelling, actually. It speaks volumes about the psychology of Tesla investors. The fact that the stock is up close to 50% since missing analysts' expectations in its May earnings report by a wide margin tells you a lot.
Yeah, what does that tell you?
It tells you how a significant portion of Tesla investors, particularly the long-term optimists, view the opportunity. It suggests that for them, the promise of the future, especially disruptive tech like robotaxis, and the whole vision of a fully autonomous network significantly outweighs the current financial performance or traditional valuation metrics.
So it's a bet on that revolutionary future, not just current profitability.
Exactly. A bet on exponential growth, fueled by belief in the vision.
So this segment really illustrates how a compelling, forward-looking vision of the future, particularly when it's tied to genuinely disruptive technology, can actually override current financial performance in the eyes of certain investors.
It's a classic battle of narratives in the market.
And right now, at least based on the recent price action, the narrative of evolutionary transformation and future potential seems to be winning in terms of actual stock movement. It raises these fundamental questions about how we, as investors, truly value a company that is constantly trying to reinvent itself and push technological boundaries.
It really does. It challenges traditional models.
So here we are. We have these two incredibly strong, diametrically opposed viewpoints, both backed by major firms. On one side, the bears waving red flags about what they see as alarmingly high valuations and deteriorating fundamentals in the core business. They're essentially ignoring the future tech, or at least heavily discounting it.
Focusing squarely on the here and now and the risks.
On the other side, the bulls are completely focused on that transformative future tech. They see Tesla's evolution into a robotics and automation company, and they're seemingly dismissing the current valuation concerns as almost irrelevant given the potential prize.
Focusing on a future horizon, a potential that maybe others can't see as clearly or don't believe in as strongly.
So how do we, the learners, reconcile these profound contradictions? How do we connect the dots here to make sense of this information for you listening?
Well, if we try to connect this to the bigger picture of how markets actually operate, it really highlights how the market can simultaneously hold these seemingly contradictory beliefs. It's fascinating.
It's not necessarily about one side being entirely right and the other entirely wrong.
Not necessarily, no. It's often more about which narrative is currently dominating investor psychology and, crucially, capital flows. Some investors are rigorously focused on immediate financial metrics, the present state of the business, adhering strictly to traditional valuation models. They're asking, what is the company earning today?
The tangible stuff.
Right. While others are prioritizing a long-term visionary narrative, what the company could become. They're betting on future earnings that may be exponentially higher. They're asking, what could this company be worth if it achieves its most ambitious goals?
It's a fascinating dance between the tangible present and the speculative future.
It really is.
And our sources use a great succinct line that sums up this struggle. They say the ticker tells the story, and so far at least it's telling us that the stock wants to and will go higher.
That's a powerful observation.
Now, that isn't necessarily a precise prediction, right? But
Yeah.
it's a powerful observation of market behavior, isn't it? It implies that despite all the valid bearish warnings, the actual movement of the stock, the price action, indicates that the dominant force, for now, is pushing it upward.
Exactly. It suggests that momentum and belief are, for this particular stock, currently outweighing those traditional concerns about valuation or near-term fundamentals.
So the market action itself is part of the story.
It absolutely is a compelling observation of market behavior, almost a philosophical statement about how certain stocks, especially narrative-driven ones, move. It speaks to the idea that market action itself, the price movement, the volume, the consistent upward trajectory despite headwinds, can be a powerful indicator of prevailing sentiment, even when that sentiment seems to defy traditional fundamental analysis.
And what does it suggest about the types of investors drawn to Tesla?
Well, it strongly suggests that the investors primarily drawn to Tesla might be those who are perhaps more interested in the belief in a transformative future, in disruptive innovation, in market leadership, maybe more so than in current profit margins or conventional valuation metrics.
They see it as a pioneering force, not just a car company.
Precisely. It almost implies a different kind of investment thesis is at play for many holders. One driven by potential rather than just present value. It's a bet on vision, you could say, not just verifiable balance sheets.
Okay. This brings us to a crucial, broader investment perspective, one that goes beyond just the intense bull and bear debate on Tesla itself. Our sources include a segment asking a very practical question. Should you invest $1,000 in Tesla right now? And it references analysis from MarketBeat.
Right, market beat. That adds a different lens.
What role does MarketBeat play here? How does it add to the picture?
Well, market beat is a valuable resource in this context because it keeps track of Wall Street's top-rated and best-performing research analysts and the stocks they recommend to their clients on a daily basis. So this isn't just the opinion of one or two firms, maybe the loudest ones. It's an aggregation that aims to provide a broader, more consensus-based view of what the top minds on Wall Street are generally advising.
So a look at the consensus, not just the extreme.
Exactly. It's a valuable counterpoint to those extreme, high-profile buy or sell calls we've just discussed. It speaks more to what the mainstream, perhaps generally more conservative analyst community recommends overall.
And the crucial detail here, a finding that adds an interesting layer of nuance when you consider all the hype and debate around Tesla, is that MarketBeat identified the 5 stocks that top analysts are quietly whispering to their clients to buy now before the broader market catches on. And Tesla wasn't on the list.
That is significant.
Yeah, it's a significant finding because it indicates that while Tesla is undoubtedly a captivating story, a stock everyone talks about, it might not be seen as the best opportunity from a broader risk-adjusted perspective right now, according to this wider analyst group.
Indeed. And the source also noted that Tesla's overall analyst rating, which is a consensus compiled from dozens of firms, is currently a hold rating. Not a buy, not a sell, but hold.
Okay, so how does this hold rating and the recommendation of other, arguably less hyped stocks fit into the intense bull-bear debate we've just dissected? What does that tell us?
Well, it suggests a more cautious, maybe a wait-and-see approach from a broader group of analysts. Even while the extreme bullish and bearish ends are battling it out very publicly, the middle ground, the consensus view, seems to be advising patience.
So the counterpoint to those loud buy or sell calls.
Exactly. It offers a crucial counterpoint to the binary buy or sell calls and implies that while Tesla's long-term potential is certainly recognized by many, its current valuation might not offer the most compelling entry point compared to other potential opportunities in the market right now. It's kind of a sophisticated way of saying, great company, fascinating story, but perhaps not the best place to put new money at this exact moment.
Right. It's not a sell call, which would imply they see fundamental problems looming large.
Yeah.
But it's definitely not a strong buy call either, at least not from this broader consensus view.
Correct.
It means that while the big names are fighting it out on specific ratings, the general consensus, or at least the quiet whisper from these top-rated analysts tracked by MarketBeat, is that there might be better buys out there right now. Stocks that maybe offer a more attractive risk-reward profile or perhaps more immediate upside potential. It encourages a more diversified perspective, looking beyond just the headline grabber.
So, for you listening, this really emphasizes the importance of looking beyond just one or two high-profile, often extreme analyst calls. It's about considering a wider array of perspectives, right? Including those who suggest that while Tesla has undeniable long-term potential and a really compelling vision, there might be other opportunities out there that offer a more attractive risk-reward profile right now.
It's a powerful lesson in not feeling overwhelmed by information overload, perhaps?
I think so, but rather seeking out the most balanced and comprehensive view available. It's about triangulating your own understanding, weighing the vision against the valuation, the hype against the fundamentals, and then making an informed decision that aligns with your own investment philosophy and risk tolerance.
It's about not just seeing the map, but understanding the different interpretations of the terrain, like we said earlier, and then deciding which path you ultimately want to take based on all that information.
Yep.
Okay, so we've taken a pretty deep dive into this fascinating tug-of-war happening with Tesla stock. On one side, you have the bears. They're warning of alarming fundamentals, extreme valuations, arguing for significant downside, really focusing on the here and now.
The present dangers.
On the other side, you have the bulls. They see a transformational robotics and automation company, an undeniable future that they believe justifies its current price, and, well, much, much more. They're focusing on a horizon few others can clearly see or maybe fully buy into yet.
The future potential.
And then there are the quiet whispers from that broader analyst consensus, suggesting other opportunities might be better buys right now, advocating for a more balanced, perhaps less speculative approach.
Given the market's historical tendency, especially for a stock like Tesla, to embrace the narrative of technological evolution and future potential over current financial challenges, it really makes you think, doesn't it?
How so?
Well, Tesla isn't just a stock. It feels like a living case study in the narrative premium. You know, the market's willingness to value a compelling future story over current financial reality. It effectively gives certain companies this belief-based valuation that can seem far beyond their immediate fundamentals. What does Tesla's journey tell us about how we truly value companies in an era of such rapid technological change, where tomorrow's potential breakthroughs might overshadow today's balance sheets?
That's really the core question, isn't it? How do you weigh tangible financials, those concrete numbers on a spreadsheet, against speculative future potential, the visionary ideas that might or might not come to fruition when you're trying to make sense of the market, especially with a company like this?
Yeah, what factors truly move the needle for you when a company presents such a compelling, yet still largely unproven vision? Is it the profit today, or is it the promise of tomorrow? Where do you place your bets?
It's a personal calculation in many ways.
And this kind of deep dive into conflicting information, whether it's about a stock like Tesla, a new technology, or really any complex topic in your life, hopefully it empowers you to ask better, more nuanced questions.
Right. To look beyond the simple answers.
Exactly. It encourages you to always look for the multifaceted story behind the headlines, to go beyond just simple pronouncements from one side or the other, and to truly try and understand the intricate dynamics at play. That allows you to form your own informed conclusions rather than just following the loudest voice.